All right, welcome to the Voices of Wall Street. I have two amazing, spectacular guests. Two of the best in the business are here with me today. We've got Jim Bianco and we've got Danielle DiMartino Booth. Both of you guys, welcome and thank you so much for being with us on Voices of Wall Street.
Thank you.
Thanks for having me.
Yeah, so let's just get it started here. I mean, what I want to hear from the two of you is right now, as you look out into the market, into the economy, Danielle, I want to start with you. Are you bullish about what you're seeing? Are you hopeful for the future? Or are you bearish? What's your general stance as it stands today?
Well, right now I'm kind of neutral. I'm waiting to see if I can go back to my civics class and understand what reconciliation is in House and Senate proceedings so that I can figure out exactly how much money and how quickly the Biden administration is going to be able to get money to people or not. So that's kind of where I am right now. I'm in a neutral pattern. We're seeing unusually sticky unemployment in this country, and it doesn't all necessarily attach itself to shutdown states. We're seeing Florida particularly weak, for example. So right now, I can't tell you where I am. So how's that for a nuanced answer?
Yeah, you're really kind of on the one hand, on the other hand. Although it seemed like it was kind of all on the one hand, right?
Well, again, money is money. Math is math. Jim and I recently participated in a roundtable with Ed Hyman, and he's been around long enough to know that if you put enough money in people's hands, something's going to happen in the economy. You will see the needle move. So if we go from 600 to 2,000, and I know people who have 3 kids and they got a check for $3,000. If that goes up by a magnitude, you're gonna see more money and a higher GDP figure. It's just math.
Right. And Jim, what about you? What are your thoughts?
Well, near term, just echoing what Danielle said, the economy is really struggling. We're recording on the day that the initial claims number came out at nearly 1 million people filing for claims, and that is a worry.
Yeah.
A lot of the alternative data, if you look at subway rides or people going to the airport or restaurant reservations, they're turning down. They're turning down right now. Even though we've got a vaccine and nearly 10 million people have been vaccinated, it's not coming fast enough, at least for this surge in the virus. So the economy is going to be troublesome, at least for the next quarter or so. But echoing what we were just talking about, we're stuffing people full of money right now. And if we get to the second half of the year and we've got north of 100 million people vaccinated and the summer comes and we get out of the house because indoor is supposedly where we transmit it the most, and then the virus goes down and the economy starts to restart, with all that money piling up, there's going to be, I think, a spending burst. And I think there's going to be inflation that's going to follow on that. And the big question for investors, as I've been trying to emphasize, is there's a difference between reflation and inflation. And right now, everybody thinks we're going to get reflation. That's real growth moving forward. If that morphs itself into inflation, that could be troublesome for financial markets throughout the second half of the year.
Yeah. And I want to just drop a couple of numbers. You talked about the unemployment or the initial jobless claims today. I think it was over 950,000 on the seasonally adjusted number. Not seasonally adjusted, just for regular claims, jumped up over 1 million. I think 1.15 million. That non-seasonally adjusted number, which is what I follow when I cover the issue. Also, I think the Biden administration, according to Axios reporting, is proposing $3 trillion in stimulus, in addition to that extra $1,400 in checks for individuals and more for families. So, yeah, Danielle, I want to kick that to you though. I mean, Jim talked about it, the potential for inflation. What's your view on the realistic possibility of us getting not just the Fed's targeted 2% inflation, but real high worrisome levels?
Well, so you don't shrink the output gap overnight. But there are some things that I'm starting to pay attention to. Very quietly, we're starting to see this percolating headline about the China, about the virus coming into China. Now, if we see what we're starting to see, which is throughout the holiday in China, throughout the Lunar New Year, if that economic activity stops, and that's what it's looking like it's happening, because this is not a Wuhan situation. Where the virus outbreak is in China right now is outside of Beijing. So you're talking about a massive economic center at this point. If we get another supply chain disruption, and supply chain disruption is where the true inflation has been feeding through. So if we see another bout of that, then you would start to think that you would see true commodities inflation. And in addition to that, the Biden administration is talking about infrastructure spending on a scale we haven't seen in a generation. So can you imagine if China's trying to keep its economy going the way it has for the last year? Remember, consumer spending in China actually decreased last year. And the reason I bring up China, again, it's the marginal driver of global growth. But if you were to see, in addition to Chinese continued infrastructure spending, this infrastructure spending on a large scale in the United States, then you could have a sustained hold steady increase in commodities price inflation that carried its way for years to come. And I don't think markets have that priced in.
And what's interesting is we're seeing the inflation right now in goods and not on the services side. The CPI number came out earlier this week. It was, pretty muted, the highest it's been since August, but still, nothing worrisome, especially on the core side. But we have really seen inflation much more baked into goods than into services. Jim, want to kick it to you. Talk to me about what you're thinking about what Danielle said. I mean, are you watching China, or what are you watching when it comes to this inflation versus reflation question?
Yeah, I am watching China, because if they really get humming, they could be a big pull on resources that could push goods inflation even higher. But you're right, during the lockdown and the immediate afterwards of the lockdown, we were all purchasing goods. Sweatpants nation is what we were. We were all about there buying laptops, getting ready to work from home.
I'm wearing sweatpants right now.
Yeah, exactly. So we've had good inflations move up. Services, we're not flying, we're not going out to restaurants, we're not going to theaters or to sporting events or the like. That could come on the second half once we get some kind of a reopening in the economy as well too. Keep in mind that as we move forward, that there is going to be a big change. One thing to keep in mind, remember, the BLS and the Commerce Department put together a basket, and that is a measure of what we spend our money on. And that goes into calculating the CPI or the inflation index. You spend X percent on housing, and X percent on education, and X percent on apparel and food and stuff.
Right.
Those baskets have been changed in the last year more than any time in history. The pandemic has forced us to rechange the way that we spend our money, and that's not getting picked up in the inflation numbers. So there's a saw going around on Wall Street that there's inflation in things you want to buy, like bicycles, and there isn't inflation in things you don't want right now, like, say, airline tickets as well. And that will change again as the reopening comes.
So as we're looking forward out into 2021, Jim, I want to ask this to you, but also send this to you, Danielle. How does that play into it? Because is the idea that once we start buying all these things, you're going to see the same inflation baked into those things that haven't seen it, that we've seen in the goods and things that have? And is that going to pick inflation back up, maybe over 3% or something like that?
I think it's going to pick inflation back up. I don't know if we're going to get all the way to 3%. Maybe on the headline number if you include the surge of energy prices. But on the core number, keep in mind, if we get to 2.6 or 2.7 on the core number, that's the highest level we would have in 30 years. So I've had this conversation with numerous people. I think inflation is going to come back. And their immediate response is, I remember the late 70s. And I was like, no, I'm not talking about 10%. I'm talking about 2.7. Well, 2.7 is not inflation. I'm like, no, it's a 30-year high is what that would be. And with the 10-year yield at 1.1, and with the stock market at a new high and a forward PE ratio of 24, that's going to be problematic, I think, for risk markets to see that kind of level of inflation, even if the Fed says that they want that level of inflation. As Danielle knows, I've often said, and I know she agrees with it, it's not up to the Fed to decide what is the level of inflation that is acceptable. It's up to the market to decide it. If the market decides 2.7 is too high or 2.6 is too high, even if Jay Powell says he's fine with it, the Fed's going to be forced to change their thinking about where inflation's going.
And Danielle, that question over to you. I mean, the Fed has talked about, really been pretty forceful, saying we need more inflation, we need more inflation. If you listen to the, I would say just the huge runaway of Fed speakers we've seen over the past week or so, there seems to be this I'll call it a pattern of saying we need inflation higher, and it seems like 2.5 would be tolerated, 2.6, 2.7. Really, if you listen to folks, it seems like they're willing to say, hey, all the way up to 3%, that's no big deal. Is that real? What do you make of that?
Officials on the Federal Open Market Committee are old enough to remember stagflation. So you find yourself saying, watch what you ask for. And remember, if you look back at what Jim is speaking to, goods inflation in 2020, what were the standout sectors? Interest rate sensitive sectors. What happens to housing and everything we pour into housing if mortgage rates come off their record lows? I think that's the last thing that Jay Powell wants, especially if you're looking at the same time as risky assets coming under pressure, to Jim's point, because the world is not prepared for higher interest rates. The refinancing wall in commercial real estate and in investment grade debt, even though investment grade debt has expanded out its average maturity, but the refinancing wall in two major sectors of the economy is gigantic in 2021, not so much in high yield. So to me at least, the Fed should be extremely careful about saying that it wants inflation, because once it comes out of its slumber, remember 1981 was the last time we were really worried about rising inflation. I mean, heck, I was in middle school. Most people in the industry, you would say the same thing. But once the genie gets let out of her bottle, the Fed's not going to have a say in where inflation goes. And I don't think policymakers understand that. They chatted up average inflation targeting,
right,
and they got a whole 10 basis point move in the 10-year. Again, they're not in charge of the narrative, except for the tips that they're buying to drive the narrative.
Right.
It's a watch what you wish for situation.
Yeah. But Danielle, I would say, I think...
Can I underscore that real quick? If you look at the last policy changes by the Fed, last year, the Fed turned very dovish and started cutting rates like mad. And that's because the pandemic came and the markets reacted to the pandemic. And within 2 weeks of their FOMC meeting in February, where they said everything's fine, they started cutting rates. The market forced them to do a 180 on their policy. The fourth quarter of 2018, they laid out a policy for reducing the balance sheet. They said it was going to be on automatic pilot, like watching paint dry. The markets didn't like that, sold off hard. Within 10 days, they did a 180 on that policy. The last two times the Fed has changed policy, the markets have forced it on them, and it's forced it on them rather quickly. And I think that that's what we need to understand. They can lay out all the plans in the world that they want, as long as the market's in agreement with them. But if the market ever changes its mind, the Fed is within days of changing policy. That's been the case the last two policy changes.
Yeah, no, I think that's absolutely correct. I was actually going to follow up, and Danielle, let me send this question to you. There seems to be an expectation in the market that, we won't get inflation, and if we do, the Fed will be able to choke it off really quickly, right? Because the Fed knows how to deal with high inflation. What's your thoughts on that?
I think it's a very convenient narrative, and it's the only narrative that makes if you look at the Shiller 10-year CAPE price to earnings ratio, it's in the 99th percentile and data back to 1881. You better stick to that narrative that the Fed's going to be able to control everything, or valuations are going to start coming back to haunt you. And I think it's amusing to hear that we're at the advent of a new secular bull market, that this is the beginning of a new 1920s. But if you look at the PE in December 1920, it was 4.8. We're sitting at a multiple that's 7 times that right now. So, and I'd like to bring up something that Jim spoke to, and that's the Fed changing its tune quickly. The Fed is running out of tools in its toolbox, and I don't think market participants have a high enough appreciation for that.
Again, wait, hold on, Danielle. I gotta ask you about that, because I think folks were saying that back in January, February of 2020, and Jay Powell hit us with QE forever, and we'll buy everything but the kitchen sink and throw the kitchen sink in too.
Yep. No, and it's, again, it works, except for the fact that there's this senator in Pennsylvania with the last name of Toomey. And so what went into the latest legislation is that they cannot just they can't just dust off the credit facilities that were rolled out on March the 23rd, 2020. They have to come up with a new mousetrap, with a new type of emergency, with something else to justify the 13.3. And people did not pay close enough attention to that, and that is going to hamstring the Fed. I'm sure that they've got people busy on Liberty Street at the New York Fed trying to figure out what the next program is that they would lay out. but the Fed is almost going to be in a position to where they have to create a black swan because they're going to have an emergency to be able to have a bazooka, in my view.
Okay, and you know, I do think though they'll have potentially. It's looking like Treasury Secretary Janet Yellen. You got that team of Jelly and JP Money, aka Dove City, as I like to call them. You know, I feel like they could come up with something that we haven't even thought about thinking about. You know.
Yeah, they could come up.
Jim can probably speak to everything that Janet Yellen has said will be appropriate under certain circumstances.
Yeah, I'll just underscore. They could come up with. They could be very creative, and they can come up with anything they want, as long as market participants are signed on to it. But if they want to try and do yield curve control or weighted average maturities extension or invent some other things, increase QE in the face of rising inflation, I think that they'll find that the market will not respond to that very well at all. And as Danielle said, you don't want to be playing those games when you have a PE ratio in the Case-Shiller's 99th percentile. Maybe if it was in the 30th percentile, you'd have a little bit more room to play those games. But you know, the old saying on Wall Street right now is we're priced for perfection, and we better get that perfection.
All right. I want to shift gears a little bit and talk about the labor market. We talked about initial jobless claims a little bit earlier, but we also had that particularly bad jobs report, lost 140,000 jobs in December. Danielle, I want to start with you. What were your thoughts about that jobs report as you dug into it, as I know you do over there at Quill Intelligence? What did you make of the jobs report and what it says about the labor market going forward?
So, you know, I wasn't as concerned with the non-farm payroll data as I was with the ADP data. And I don't normally fall back on ADP, but it's the construct. It's the fact that the smallest businesses, which unfortunately we've gotten used to permanent closures, it was a barbell weighting between the largest companies and the smallest companies. So my concern right now is that, you know, a mentor of both of ours, David Kotok, you know, he talks about survivorship bias, and I think we're seeing a lot of that in the soft data right now. But large corporations in America are using this pandemic and using this time of economic disruption to use their stock as currency to buy other companies because their stock is so expensive, so they can acquire a lot more than they could otherwise. But you're going to get synergies out of that. And on top of that, I think corporate America is looking at this as an opportunity to cut out middle management, right, and make permanent cost-cutting measures, move forward with automation at an accelerated pace. And these are jobs. My greatest concern, to use a phrase that Carmen Reinhart's been using a lot lately, I'm a big fan of her as an economist, but the scarring is not being taken into effect. And a lot of these decent paying jobs are not going to come back. In addition to the fact that it's going to be so difficult to get the small business machine up and running. I'm not talking about PPP loans out to existing companies. I'm talking about fresh, new companies. I know census data shows that there's been a lot of businesses created, but hop onto my LinkedIn thread one day and everybody and their dog is advertising the same exact thing because they've all had to go out and hang their own shingle. So that's not something that I would consider to be that is a positive for sustained improvement in incomes.
Yeah, this is something I've been writing a lot about in the Axios Markets newsletter, is just this, the way business is changing. Jim, if you could speak to that a little bit, have you been watching this change in business that seems to be going on, and what does that tell you about the future of the labor market?
Yeah, the thing that has got my focus the most is about 30% of jobs in America can be effectively done work at home. All three of us can effectively work at home, and in fact, we are. 70% of jobs in America can't. A surgeon can't work at home. A waitress can't work at home. A taxi driver can't work at home either. So we're going to have some kind of a major restructuring of the economy if we're going to have, even in the restart, we're going to have a lot of people, of those 30%, staying home 1 or 2 days a week. The ancillary services in the big metropolitan areas, the stores and the restaurants that feed everybody at lunch, you're not going to need as many of those. Even the office towers that we all used to go back to. If we're only going to go back 3 or 4 days a week, or 1 or 2, we're going to need 20 to 40% less office space if we're not going to go back as much. There's going to have to be a rethink there. So the economy is going to have some kind of a major restructuring here. And unfortunately, a lot of the higher end jobs can be done at home. Not all of them, but a lot of them can be done at home. And I don't think that those people that are doing their jobs effectively at home are appreciating what's going to happen when we go to the reopening too. And the last thing I'd give you too is I see the surveys that everybody says, I want to go back to work when the reopening starts. But anecdotally, everybody tells me, yeah, a couple of days a week. I don't want to go back 5 days a week. And I know, like on Wall Street, the banks are insisting on getting everybody back 5 days a week. Nobody wants to do that right now. They'll go back a couple days a week, but they don't want to go back every day. I think we've learned we can do this effectively at home, and this is going to become a new thing, to Danielle's point about cutting out middle management. I don't need those guys walking around managing everybody if we're all at home doing it like we have for a year.
And let's get rid of those guys for good, right?
Yeah.
Yeah. So last question I want to ask you, because what you spoke to is something that former ECB President Mario Draghi actually spoke to me about a month ago, was saying this, a lot of this is being masked right now because of all of the central bank easing and the fiscal stimulus. And so we're not seeing it. On that note, one thing that I think has really taken the world by storm is Bitcoin and cryptocurrency. And a lot of serious folks have kind of dismissed it. But as I wrote about last week, more of these big financial institutions are embracing it. You see, Mass Mutual, as someone said, your grandfather's insurance company is now getting into Bitcoin. Danielle, first with you, and Jim, I'd love to get your thoughts, and this will be the last question I ask. What are your thoughts on Bitcoin, where it is, what its future is, and the kind of, I know a lot of folks have described it as a mania, but just the excitement about it right now?
Well, so there are parallels between today and 1999, 2000. When you have an anger element that's associated with the security, and when you talk to people about Bitcoin and Tesla on social media, which was a platform that didn't exist in 1999 and 2000, but they get angry. They're foaming at the mouth, crazy people. A lot of them. Don't get me wrong.
Yeah.
I look at Bitcoin as being, the next generation of pushback against fiat currency that used to be expressed through precious metals. So it's not so much that it doesn't have efficacy and the ability to have staying power. It's not that we're going to turn the hands of time back at all. But right now, the behavior of the security itself is you can probably have a nice correlation between it and Tesla. If something doesn't make sense, then I'm just speaking about price-wise, then it's going to correct itself. Does that mean that digital currencies are not going to be with us for the rest of time? Absolutely not. But again, nobody knows what the effect of governments looking at their own digital currency. Nobody knows what the effect is going to be on Bitcoin and private cryptocurrencies. And this theory that Bitcoin is going to be just adopted and take out the reserve currency status of countries, there's an implicit assumption that you're putting away 500 years of history, and the fact that countries don't necessarily want to be taken out of the picture. And I mean, that takes us back to where I started this discussion, which is China. So it all sounds good in theory, but then you have to bring back into it the fact that we are a global economy, and there are going to be economic superpowers who want to be able to have a weapon of their own, as we have weaponized the dollar.
And Daniel, when you talk about China, are you talking about the digital renminbi or the way that they're mining Bitcoin?
No, I'm talking about the digital yuan and how they're rolling it out,
Gotcha.
how they're looking at it on a practical level. They're continuously doing a study here in this city, a study there in that city. And by the way, if they truly are sitting on top of quantum, that changes the economics of Bitcoin in a big way.
Right, yeah. Jim, what are your thoughts?
Two, first of all, I do think longer term, bigger picture, if you will, that the dollar will lose its reserve currency to some kind of a digital currency. Now, that's not happening this year. That's not happening next year. Probably not.
No, wait, Jim, is that a digital dollar or is that a digital renminbi or something like a Bitcoin when you say lose its status?
I don't think it's going to be a digital fiat, if you will. We're not going to change it from a digital dollar. Also, I think we're going to have a hard time creating a digital dollar. The Fed has already pointed this out in their numerous talks that they're looking at Fed coin is what it's been monikered, their digital US dollar. The problem with that is if you create it, you need a way to have people to be able to use it, which is a fancy way of saying, I need an account at the Federal Reserve in order to use their digital dollar. Well, if you do that, then I don't know what purpose JP Morgan or Citi or Bank of America serve anymore. If I can put my money with the Fed and in a digital dollar. And if you're going to say, no, we'll create a digital dollar and let JP Morgan and Citi and Wells Fargo be the front end, then what's the point? You haven't accomplished anything at that point.
And actually, real quick, Jim, I just want to jump in. I was speaking with the incoming Senate Banking Committee Chair Sherrod Brown, and he's saying this is exactly what he's trying to do: is set up these Fed accounts so that people can hold their banks directly with the Federal Reserve. So that's at least on the mind of some policymakers.
Right, except it's not on the mind of Jamie Dimon. That's the thing that will keep him up at night if he has to compete with the government and the Federal Reserve in the deposit taking business, where he doesn't have to compete with it right now. So I think it's going to be more likely it's going to be a crypto. Is it going to be Bitcoin? I've used the analogy of the search engines. First we had Alta Vista and that went out of business. We had Lycos, that went bankrupt. Then we had Yahoo and that was very successful. Then we got Google and everything changed. Maybe Bitcoin is more towards the Alta Vista scale on that, or maybe it's more towards the Yahoo scale on that. I'm not sure. But I think that somewhere down the line, either with enough forks in Bitcoin, where they've changed the programming of it, or a new currency, cryptocurrency altogether, that we're going to get some kind of a major adoption of that currency. And last thought for you, I think I'll term it inside out. When you get a cryptocurrency that will get adopted as a medium of exchange, it will probably start in the third world, because the third world has high cell phone adoption because they've never really had landlines, and they're getting very comfortable with digital payments anyway. If you go to Kenya, M-Pesa is huge in Kenya. They do more digital payments in Kenya with our second generation cell phones than we do in the United States. So it will come there. They will use it as their form of currency. It will spread throughout the third world, then, if you will, into the second world, and then into the first world. Probably the last place it will come, because it will be forced screaming and kicking into it, is the United States, because we're the reserve currency and don't want to give that up. Everybody else will give it up, and then we'll be forced to adopt it as well, too. But this is a process that will take a while to unfold.